Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner and owner and founder of Menninger Associates Financial Planning. Pleased to have Nick DeVito, one of my associates, also a CFP and a minority business owner of the firm. Nick, thanks for joining me.
Thanks for having me.
And congratulations on being the one who happens to be with me for marking our 200th episode of Financial Planning Explained. This has been going on for a few years. Started off as a TV show that was on Roku, disconnected with the TV station, and just continued to propagate it going forward with YouTube, as well as all of the podcasts. And we share it on LinkedIn and we share it on Facebook. And we have, I think it's about 1,500 subscribers on YouTube. And we have somewhere between 4,500 and 5,000 subscribers on iTunes and Spotify, of which I'm also pleased to announce that my understanding is that we're, from the category of financial planning, we're the number one financial planning podcast in the country.
Wow.
Which probably explains why we're getting calls from people all over the country, which is cool. Speaking of which, I meant to tell you about Bill from Indiana. Purdue is the number one team in the country. They went down this weekend.
I was talking about that last week.
Oh, were you? All right. Anyway, so we get the opportunity of connecting with people from all over the country. It's kind of cool. All right. So anyway, what we're going to talk about is, it still is December, but guess what? We're going to talk about beginning of year planning. And some of the beginning of year planning are actually going to touch upon a little bit of year end. So I guess it's kind of good because it gives you ability to project forward, but also to take a look at some of the things that maybe consider doing before the end of the year, before we start planning for the new year.
Well, and they go hand in hand because oftentimes you'll be doing your sort of next year planning at the end of year planning for the prior year, because you're at least thinking about, okay, you're closing the book on 2025. What are we going to be doing in future years? And two, they go hand in hand because your beginning of the year plan is going to determine what your end of the year plan is too. So they do go hand in hand there, and there are opportunities that, particularly today, we're going to be talking about the opportunities and things you want to be considering at the beginning of the year, but it ties into end of year as well, just like you said.
Right. And in most cases, and for most people, and this is why we're really busy in the Q4 of every year, in most cases, there's very few things you can do after December 31st, at least for the prior year. The only people that really impacts are people who are self-employed and have the ability to make certain types of profits and contributions to retirement plans, et cetera, by the time they file their taxes. And to a much lesser extent, people who may not have a retirement plan but are working have the ability to contribute to an IRA. But other than that, I would say probably 95 to 98% of the people, at least,
the book closes on December 31st.
That's correct.
Yeah.
That's correct. So what are the basic things that we look at? I would say the two things the primary things are looking ahead at your income, your taxes, your cash flow, and all of that, because those drive most other decisions.
Yeah, exactly.
So let's start with making contributions to your retirement plans. And I'm going to talk about that one first, simply because of the fact that how many times do we run across people in the middle of the year, we meet them for the first time, and they goofed things up at the beginning of the year that you can't fix anymore.
Yeah, and both typically pertaining to the retirement plans, one thing we'll see, and I'm sure what you're getting at, is we'll see people missing out on the employer match. Maybe they just didn't understand how their employer match works with their 401k. Sometimes HSAs, they provide a match, all these different types of retirement plans, but it really starts with understanding how your plan works. And you want to know that at the beginning of the year so you can plan your contributions accordingly. Maybe you receive a 4% match, but in order to get that, you have to contribute 6%. I've seen people mess that up where they come in, they say, oh, I was doing 4%. That's what the match is. Well, no, you actually have to contribute 6% to get the 4% match. And for however long until they met with us, they weren't getting that match and they were missing out on that free money. So understanding that and making sure that you're at least doing the minimum to get the match is key. Another thing too, the flip side of that coin is that they were doing too much. and that they maxed out their 401k halfway through the year, 3/4 of the way through the year. And then if it's a true match that your employer is doing, well, if you're not contributing for 3 months out of the year, what are they matching? Nothing. So that's something you need to be considering. You need to be structuring your contributions accordingly, especially sometimes too, what you'll see happen is maybe they get a bonus. And if they're taking that same percentage out of a bonus, that might throw off your projections for the year. So if you're saying, oh, well, to get the full match, I need to do 10% every paycheck, and that'll get me to max out my 401k and receive the full match throughout the course of the year, but you don't account for 10% of your bonus that gets paid out in March, well, that might mess up your plans a little bit. So I think having that plan in place before you start the year or at the beginning of the year is key.
Well, I'll go one step further. If you're age 50 and over, you're allowed to have what's called a catch-up contribution to your 401k. And that basically, in 2025 numbers, the basic contribution limit is 23,500, but catch-up is 7,500. Well, what a lot of plans don't match catch-up. And this is the terminology that I used, kind of goes back to electrical engineering, is series versus parallel. What do I mean by that? Is, let's say the aggregate is $32,000 and people are contributing and they hit their max on their normal contribution. And then in the last few months, they're doing catch up. Well, the problem is I would say most plans, maybe 2/3, I would say, do not match catch up. And if they don't match catch up, then what happens effectively in the last several months of the year, while they're only contributing to catch up, they're not getting the full match or any match.
Yeah.
So it's a function of really knowing and understanding the rules of the 401k plan to then develop what is my my contribution strategy to, at a minimum, maximize company match.
Yeah, and there are ways to mitigate this. You'll see sometimes plans will have a true up where as long as you got X% in by the end of the year, they'll bump you up to whatever the match would have been. So you'll see that, but oftentimes that isn't the case. So knowing going in is very important. Another thing too, and this is a little bit more tax planning, more so than retirement planning, is sometimes if you're straddling a threshold, and we're using straddling a tax threshold, let me be clear there, and we're using your 401k as a way to mitigate that. Sometimes what we'll have people do is we'll say, okay, starting in the beginning of the year, we're going to have you contribute the minimum required to get the match. And let's say we'll go pre-tax there.
It's usually the case.
Yeah, typically we'll start with the pre-tax. And then we say, okay, halfway through the year, we're going to evaluate where you're at. And at that point, we can then either continue doing the pre-tax and ramping it up a little bit so you get the full amount in for the year. Or we say, okay, you know what? We're actually going to be under the threshold that we thought we might be over. Let's switch to Roth. And at least it gives you that flexibility. But once again, if you go into the year not planning for that, you don't have that flexibility. And anytime you're doing financial planning, you want to have as much flexibility built in as possible.
And to Nick's point, usually what we do in those circumstances and is when we're hovering across a line and it's usually folks who are between the 24 and 32% line, which is basically about $400,000 of income, is we typically will use the pre-tax in the beginning of the year, and we only put in the exact amount that we know we're going to get the full match. The reason is because in most cases, you have the ability to increase your income by doing things later in the year. But if you were contributing to Roth, there's very few things you can do to reduce your income. The other thing that take for instance, let's say someone's hovering along the line. If we're contributing to pre-tax, and to your point, we realize in September that, we got no problem. The bonus was a lot less than we thought. Income raise didn't go, or other extenuating circumstances in someone's financial life are such that their income is going to be lower. We then have the ability to flip the switch and go to Roth. And if we wanted to increase the income, we could always do a Roth IRA conversion. Or in some cases, we may take capital gains or what have you. It gives more flexibility later in the year.
Yeah, because to Mike's point, you can find ways to increase your income. It's much more difficult to be finding those deductions. And that's a situation I ran into very recently. A client got laid off. they were receiving severance at the end of the year, and it pushed them up into that 32% tax bracket. Now, there's nothing you can do about that. The beginning of the year planning wouldn't have really helped there that much anyways, because you really can anticipate that, and especially it came in the last month of the year, so how the heck are you going to be planning for that throughout the whole year? But to Mike's point, finding those deductions is a lot trickier than being able to add increase your income.
That's correct. And so one of the other things I like to point out for people who may have struggled a little bit with their cash flow, and again, people with higher incomes, is if making too big of a contribution to their 401k struggles with their cash flow, one of the things that we always have the ability to take into consideration is, if someone's making 200,000, what's going to happen is they're going to exceed their Social Security wage base. And if they exceed their Social Security wage base, which is right now 176,000, is once they reach that wage base, they're no longer withholding Social Security, which ends up being a raise of several $100s per pay. In fact, if you really get down to it, 6.2%, and that's on the after-tax side.
Yeah.
That gives them the ability to really step up to either 6 or 8% more than they were previously contributing, allowing them to really step up their contributions at the end of the year. Mm-hmm. So in a lot of cases, what we do is for those clients who are teetering, what we'll do at the beginning of the year is say, all right, everybody knows when they get that raise or when they reach the top of the Social Security, all of a sudden, hey, holy cow, my paycheck just went up by $500 or $600. Well, there you go. And then we use that as a tickler to give us a call and say, all right, it's time to reevaluate for the rest of the year. So we use that sometimes as a way of looking.
And sometimes we'll actually use that as a way to pay for Roth conversions too. I've used that as a strategy as well, where that raise, we say, okay, let's say maybe cash flow was an issue, but they were comfortable with where their cash flow is at, but we know we're going to do a Roth conversion at some point that year. That point in time where they've reached the wage base could be the catalyst. Say, okay, you either that extra money you get, you sock away into a savings account to pay taxes later, or you have it withheld directly from your paycheck. Some people prefer that. So that's a great opportunity for people to take advantage of as well, whether it's to increase cash flow, pay the tax bill at the end of the year. I've seen it used many different ways.
Right. There's multiple ways of skinning a cat. And if we've never said it 100 times before, we're going to say it again. One of the most important components of financial planning that you can do for yourself is create flexibility, because the only thing in life that's guaranteed, the G word that we're not allowed to use, but the only thing in life that's guaranteed, everybody says death and taxes. I'll give you the death part. The only thing in life that's guaranteed is nothing is guaranteed. So on that note, I think we're at a good point to take a break. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're continuing talking about beginning of the year planning, which it's weird. You always talk about something spills over into the following year. Here's the beginning of the year planning that spills over to prior year. Mm-hmm. Because, some of the planning that you're doing for next year may also be accomplished at the end of the year, but be that as it may. Going back, we talked mostly in the first segment, we were talking about utilizing the 401k, the amount to put in, et cetera, et cetera. But what we didn't talk about is whether or not you contribute to the traditional or to the Roth. And I'm going to ask Nick, and I guarantee you that he comes up with the correct answer. Nick, what's better, the traditional or Roth?
It depends.
See that? And our clients are catching on too. We always ask them the question in the beginning of the meeting, we'll throw it out there. And when they come up with the answer, it depends, we applaud them.
Yeah, because and then we hear that maybe 5 other times throughout. Anytime we ask a question after that, it depends. Yup, you're right.
There you go. At least we know that the clients were listening. Yeah. But anyway, so the long and short of it is, what you really want to be doing at the beginning of the year is projecting out what you anticipate your income's going to be. And, we do this every day. And most of the viewers and most people don't. So at least at the beginning of the year, when I say we do this every day, is literally projecting income. And we have software that allows us to take pay stubs and project out for the rest of the year, and just utilizing prior year taxes and just our knowledge and understanding of all the different tools that we have at our fingertips. Typically, you can do the beginning of the year planning. And at the beginning of the year, oftentimes is when we're trying to project, are you better served contributing to the pre-tax traditional or the after-tax or tax-free growth Roth? And, we talked about earlier, for those people who are hovering along the line, you go pre-tax until you know better, but, evaluate and go with the right one.
Mm-hmm. Yeah. I mean, what it really comes down to, the it depends that we're referencing is, what is your tax rate today? What do you anticipate it being in the future? And then the second step to that is, okay, well, what is your tax rate today? If we're trying to compare the two, sure, there's some projection that goes into figuring out what your tax rate's going to be in the future. But if you can estimate what your tax rate is going to be through for the current year, the upcoming year, that's how you can make that decision. Now, some people, their income is more stable than others. A lot of people say, you know what, I make about the same each year. So that beginning of the year evaluation, there's not as much projection that goes into it. And you can say, okay, I know I'm going to be in the 22% bracket this year because I've always been in the 22% bracket and I don't anticipate anything changing. That's easy enough. Kind of going back to what we said in the first part of this episode was, it's the planning really relies heavily for those people that have the variability in income, and that's where you want to build in that flexibility.
Right. And so what happens a lot of times is, back to the whole traditional versus Roth, if we know pretty confidently that a person is going to be in a lower income tax bracket now than they're going to be in retirement, we're always recommending contributing to the Roth 401k, contributing to the Roth IRA, of which, even in the beginning of the year, contributing to a Roth IRA is one that a lot of people have the ability to do until April 15th. And it's predicated upon your adjusted gross income. Sometimes people don't know exactly what it's going to be and whether they're in the phase out or not in the phase out. But, because it's 236 to 246,000 adjusted gross income for a married couple. Well, the problem is sometimes you don't know what it's going to be because you have year-end distributions. You've got other things. You don't have your W-2 yet, and you're cutting it close. But you still have until April 15th to make a contribution if you're eligible to a traditional IRA and to a Roth IRA. But to be clear, unlike people who want to do an extension, you can extend, but two things to know about doing an extension of your filing taxes. Number one, it does not extend the deadline for contributing to an IRA or a Roth IRA. And number two is, it doesn't mean you get to extend how much you owe.
Yeah.
If you owe $10,000, then you need to get that in on April 15th. And if it turns out you fill out your taxes and you owed 11, that's going to be a late payment penalty for that $1,000.
And just to clarify, the deadline of April 15th that Mike is talking about for the Roth IRA and traditional IRA contributions, that's for prior year contributions.
Correct.
So you have up until the following year, April 15th. So for example, your 2025 Roth or traditional IRA contributions can be made up until April 15th of 2026. So to Mike's point, if you are teetering, and sometimes we'll use it as a tool, a flexibility tool, where if they're teetering and they maybe go over a little bit higher than we thought, then we use the prior year IRA contribution to knock them back down to below the certain threshold that we were taking a look at. So it is a flexibility tool there. It's kind of end of year and beginning of year planning, because it's really, you're doing the planning for the prior year, but it's in the beginning of the new year. So that's just another tool that you have available to you.
So one of the things that we do a lot of in January is Roth IRA conversions. And he's like, well, gee, January, why? Because you get a full year of tax-free growth. Okay. And so got a handful of clients that we know we're trying to take down their total amount of pre-tax assets. And, I think there's reason to believe, based upon the historically low tax rates today, the projection of in retirement, then having to take the money out, running the risk of Medicare premiums having to go up based on your income, which is income-related monthly adjustment amount, or IRMA. There's a lot of reasons why it is possible people are in a higher income tax bracket in retirement than they are today. And so what we do a lot of times is we'll be doing Roth IRA conversions in January. What's a Roth IRA conversion? That's moving money from your IRA over to your Roth and paying tax in today's tax rates. So if you do that, at least at the beginning of the year, assuming we have growth, you have a full year of tax-free growth. Well, the thing to take into consideration is we have a lot of clients who do that, but then are relying, they're retired already, okay? And they're relying on the income from their IRA or Roth IRA for cash flow. So perfect example is, in many cases, we're doing a Roth IRA conversion of, say, $100,000 in January. We know at the end of the year that they're going to have a $20,000 tax bill too. We also are doing $3,000 a month of distributions from their of money. So what we do in January, we say, all right, we're going to convert $100,000 from IRA to Roth, and then we carve out the $20,000 that we're going to owe for taxes, and then the $3,000 a month, or 36 grand, we carve out that $56,000 because you don't ever want to be forced to take money from an investment if it's gone down by putting it into a guaranteed money market. Okay, using that word guarantee, but in money market or something that has very low volatility, at least what you're doing is you're assuring that you're pulling from an account that's not going down. And, oh, by the way, all on a tax-free side of the ledger. So if we moved $100,000 over and you're earning 4% in money market, which is going to go down a little bit now, but just call it for the sake of math, you now have $4,000 that's growing tax-free, or at least the $56,000 that we carved out. At 4%, you're earning over $2,000 on the tax-free side of the ledger.
Yeah, and that's really key when it comes to beginning of the year planning. Cash flow planning at the beginning of the year is imperative, because then that allows you to determine, okay, well, I know I'm going to need X amount of dollars a month. How do I pull that in the most tax efficient manner? To Mike's point, we'll do the Roth conversion strategy where we convert at the beginning of the year, distribute from the Roth, so at least you're earning the interest on the tax-free side of the ledger. But that also might not mean it's coming from the Roth IRA. You could want to be taking money from a non-qualified account, a non-retirement, just normal investment account. And if you're doing that, well, there's going to be a tax implication of that. If you need to be creating the cash, you might be dealing with capital gains or capital losses. So taking a look at that at the beginning of the year, determining how much you're going to need. And then from there, you can determine, okay, what is the funding source of my cash flow needs? That allows you to really set yourself up nicely for the year to come.
So there you go. And so if you take a look at all of the things that we're talking about on these planning are very, very much around taxes and cash flow. And, cash flow is, well, how much money do I need during the course of the year? At which point, now you're taking a look at your investments to make sure that you're going to provide that. And then lastly, you're also taking a look at your tax component to isolate or identify and calculate how much should I do in Roth IRA conversions. And again, so in some cases, the example that I used, we did a $100,000 Roth conversion for somebody who is in retirement. For those people who aren't in retirement, who have variability in cash, in taxable income, oftentimes business owners or people who get bonuses during the course of the year but don't really know. So what we'll do is, let's say, for instance, we say, hey, based on last year, we were going to do a $200,000 Roth IRA conversion at the beginning of the year, which makes sense. But what we'll do at the beginning of the year is say, hey, all right, let's take a closer look at what your anticipated income is going to be for the year, but what is the potential variability of it? All right, what's the lowest it could possibly be and the highest it could possibly be? And what we'll do is, if there might be as much as a $50,000 variability, what we'll do is we'll do $150,000 in January, and then we wait until the end of the year when we're doing all of our tax calculations, et cetera, and then we figure out exactly how much they could have converted at the end of the year. And many times we get underestimates. We're like, holy smokes, we got a much bigger, and then we're like, wow, it's a good thing we only did 150, because unfortunately, under the 2018 tax law changes, the one thing that I can't stand is that the Roth IRA conversion is not reversible. Because what we used to do is, do the whole 200, and if we go over, no big deal, you back it down. It's irreversible now. And that's the one part of the laws that I can't stand, which is what makes our Q4 so bad.
Yeah. And kind of going off that, a lot of the beginning of the year tax planning that we talked about is preventative. It's maximizing efficiency. It's making sure that you're receiving the full match. Most of which, if you don't do, it's not the end of the world, and some of which you can actually make up for at the end of the year, whether it's Roth conversions or capital gains or capital loss harvesting. The one thing you can't make up for, which we haven't talked about yet, is quarterly estimated payments. If you determine, and this is a perfect beginning of the year planning item, if you determine you are going to need to be making quarterly estimated payments throughout the year, maybe you're a business owner that is going to have profit where you're going to need to be making quarterly estimated payments. Maybe you're doing Roth conversions and need to do quarterly estimated payments. If you're doing them, you need to be doing them throughout the course of the year. You can't just do one at the end of the year. So that certainly is a beginning of the year tax planning item where if you're going to be doing them, know what that number is. If you're working off of 100% or 110% of last year's total tax, you know what that number is going to be going into that year. Make sure you're doing your quarterly estimated payments along the way so that you're not getting dinged with that under withholding penalty. And in order to know what that quarterly estimated payment is going to be, you have to do your beginning of the year tax planning.
That's correct. And, the alternative to the quarterly estimated payments, which we all know are kind of a pain in the butt, I know what I personally do, and we recommend with a lot of people, increase the withholdings in your paycheck. You can increase your state withholdings, you can increase your federal withholdings, because if you have a lot of dividends and stuff that are outside, your paycheck doesn't know that. Your payroll is going to withhold exactly 3.07% of your gross income, which means at the end of the year, if you had no other income, you're always going to break even at the state and local. It's when you have other ancillary income, whether it be side businesses, investment income, or stuff like that, that you may just choose. It's so much easier to just have it withheld an extra 20 or 50 bucks per pay from your paycheck. But again, at the beginning of the year what that might be. We've had so many times that we meet with people in October, November, and we look like, holy smokes, you're going to have about a $6,000 or $8,000 tax owed. Okay. It's a whole lot easier. Let's call it $5,200. If you had a $5,200 tax payment that's going to be due, it's certainly a lot easier to withhold an extra $100 a week than it is to be coughing up $5,200 come tax time. Not to mention the odds are with a big tax, there's going to be a tax penalty.
Well, and to go off that, what you'll find sometimes is if you're married, to Mike's point, from a state and local standpoint, that's taken care of. If your state has a flat tax rate and your only income is through your paycheck, you're typically not going to have issues there. Also, from a federal level, if you're single and it's only your income and your filing status on your paycheck or through your payroll company is correct, you're probably not going to run into issues there. What I see people run into issues when they're married because the payroll companies only know what is going through them. For example, if I have a job making $100,000 and my wife has a job making $100,000, they don't know that the other person's making $100,000. So they're basing my withholdings. If I say, oh, I'm married, what I'll see is people say, oh, I'm married, I have one dependent, and that's all the information that the payroll company has, and they don't know about the other money because how could they? The other income, I should say, you're going to under withhold. And then people get that surprise tax bill at the end of the year, to Mike's point, and they have to come up with all this money and there's a penalty. So knowing that at the beginning of the year, if you've historically been someone that owes a bunch and you're tired of it, take a look at that at the beginning of the year. Maybe consider increasing your paycheck withholding so it's not as much of a burden at the end of the year.
And to increase your paycheck withholdings, it could be done through your payroll where you change your W-4. Now, they've made the W-4 a whole lot more complex. Now, to put it into perspective, to Nick's point, the reason why this was a killer was actually with the 2018 tax law changes, the algorithms that went into payroll didn't keep up with it. And as a result, it was really in 2018 that we identified in May, we looked at a client, we're like, holy smokes, you're going to be looking at an $8,000 tax owed. In fact, we actually picked up the phone and called our CPA friends and said, hey, look, guys, this is what's going on out there. We want to give you the heads up because guess what? Come April of the following year, if they go in to see their accountant and they owe $8,000, trust me when I tell you, they're not going to be happy, and they're often going to blame the accountant, and it's not the accountant's fault. But here we are, because we identify it, we look at that stuff in advance. So it's just be cognizant of that exists out there, that there are ways that you can do the tax withholding from your paycheck. And it's a whole lot easier to do $100 a week than it is $5,000 at the end of the year. So I think that's about it that we're going to be talking about. Again, the main issue here is proper prior planning prevents poor performance. Nobody plans to fail, they fail to plan, all those old cliches. The reality of it is that it's always good to plan. Plan for taxes, plan for your 401k, plan for cash flow. When you do all these planning things, you're going to save money almost inevitably.
Not only that, build the flexibility too. We talked a lot about that, building in the flexibility. So you want to plan and build that flexibility are the two things I would say beginning of the year tax planning is really important for.
Right. Okay. So anyway, at the conclusion of our 200th episode, what I would like to be able to do is say thank you to all of our viewers who have been there all this time, who have generated the flow to make us the top podcast in the country, as well as all of the viewership that we're getting with YouTube and through LinkedIn, et cetera, et cetera. Thank you for your support. And to a great extent, I really hope ultimately at the end of the day that you're learning something, that you're able to apply it to your daily life to help improve your financial situation for today and in the future. And as always, if you ever want to reach out to us, please be welcome to check out our website, which is www.maaplanning.com, which is like Menninger and Associates, MAA, www.maaplanning.com, or you're more than welcome to call us at the office. Phone number is 610-422-3773. Thank you very much. Thank you, Nick.
Yep. Thanks for having me.
Thank you. And you have a wonderful day and a great, great and terrific week.